baby, the end of an era is upon us. After all these years, we are finally seeing our first interest rate cuts. Canada is leading the cause, being one of the first countries to do this. We're going to talk about what it means for your portfolio, because I bought about $5,000 worth of Canadian stocks today to kind of take advantage of what's going to be coming in the next 6 to 12 months. We're going to talk about what this means for the US, and if that is a conversation you'd appreciate, damn it, hit that like button, because here's Tiff Macklin, our own version, of course, of Jerome Powell.
Well, let's go live now to Ottawa, where Bank of Canada Governor Tiff Macklin is discussing today's rate decision.
To 4.75%. We've come a long way in the fight against inflation, and our confidence that inflation will continue to move closer to the 2% target has increased in recent months. The considerable progress we've made restoring price stability is welcome news for Canadians. Since our monetary policy report in April, underlying inflation has continued to ease and economic growth has resumed. With the economy in excess supply, there is room for growth even as inflation continues to ease. Le Conseil de Direction.
We don't need the French interpretation, but you have to recognize that this is very potentially and still very likely the first soft landing in economic history. I mean, realistically, in our lifetimes, we'll probably never see anything quite like this again, considering this is the highest interest rates have been in well over a decade. And there's good reason to start cutting it as we take a look at some of the data. And my anticipation is, he said, there's no rush to keep cutting rates aggressively. So long as the data remains good, they'll keep progressively cutting. I think it'll take probably more than 12 to 24 months, I think, to get back down to a reasonable interest rate, which to me is somewhere probably back up to this higher level between 1% and 2%. People say they'll never go back that low. You watch, give it time. Rates are going to come down because low interest rates aren't what caused the inflationary pressures. It was helicopter printing from the pandemic, right? And we need lower rates because people don't want to build housing right now. I mean, for new construction guys to build a house and take on high rates and a 5-year construction project is insane. For new people trying to buy those new construction builds is insane at 5 or 6%. So we need rates to start coming down, and it's all based off this data, right? Canada is one of the few countries right now that is hovering in the 2% inflation rate range for pretty much the entirety of this year. So there's no surprise that they said, hey, we're back down to a 2% target area. Let's slowly start cutting rates and let's see what happens, right? In the US, however, we're not there yet. Inflation has been sticky, but it's been self-inflicted sticky. We're talking about oil prices. We're talking about housing costs. Those have been what have been driving the inflationary pressures, primarily in Canada and the US. So they should cut rates. In my opinion, at this point in the cycle, it would benefit the economy better to cut, even though you're still at this 3% area. But if they're really just following the data, it's unlikely that Jerome will cut rates. Time will tell. We'll see. Canada's leading the charge, though. So it looks like the states are going to lag up at this 5.5%, whereas Canada, as it stands today, is going to be dropping down to the 4.75, never reaching the same lengths as the US did. So what does this mean for the economy? What does this mean for stocks? Well, unfortunately, nothing right now. I mean, we're not seeing hardly any movements in stocks as it stands in this moment. Now, we are seeing some secular movements, which is largely anticipated. Real estate, we're seeing the Vanguard Canadian Cap REIT Index jumping up a little bit here, almost, it's up nicely, over 1%. People are saying, like, shouldn't we have been seeing more of a jerky reaction? And the real kind of question here is it priced into the market? I don't really know, but what I do know is it's going to lag the effect on earnings. I think you still have time to take effect of the recovery plays, because what's going to happen here is over time, when they keep cutting rates, and I think it's going to take about 1 to 1.5 percentage point cut, at least a percentage point cut, and then you have to give it probably 3 to 6 months before you see it hit earnings, because a lot of these companies might be using line of credits and corporate credit and stuff like that, and they've seen the rates slowly affect their earnings, but then we'll start to see it affect the earnings in the other direction as their interest payments start finally going down for the first time in quite a few years. So companies like Fortis are jumping up a little bit today. You're going to see utilities benefit greatly from this because they're infrastructure heavy. Also, companies like Enbridge, these are heavily debted companies. They have a lot of capital intensity in their business, and they're going to benefit. You're going to see venture capital eventually start to benefit. So smaller caps should start to rally better off this. Telecom giants, especially things like TELUS, that have just been eating up literally like $1 billion in just, payments to debt. These companies like Bell, I mean, I'd pay close attention to these because right now they're yielding insanely large amounts of dividends. And I'm curious if this is the final bottoming in their stock prices as we start to see some recovery. The banks, The banks, I think, would benefit better from a higher interest rate environment because they make more interest income. But the problem is the renewal on mortgages and people that have debt and just loans, their credit quality has gone down, leading to higher loan loss provisions, which have been hindering their earnings. But the banks here are in an interesting place. I think if we get back to around a 2 to 3% interest rate average, the banks will still be in an environment where interest rates are higher, which means they'll make more money, but credit quality will start leveling off and get to a place of a stronger position, so they won't have to do as much loan losses. That's what we're really trying to see for the banks when loan losses stop going up. That's where I think you're going to get the best bang for your buck when earnings will start to recover in the banks. So I've gone ahead and I bought more VDY today. I put about $5,000 in here because it's my favorite position to get exposure to the Canadian markets, because a lot of the companies in here are going to benefit. I still think the banks are at a great value. So I sunk in another, like I said, 5Gs. I had some room in my RSP, still got more room. Looking at some, again, US REITs like O Realty, looking for some recovery plays in the States, because I think we're finally getting to that point of the interest rate cut cycle. VDY is not a material position in my portfolio. I have 377 shares. I'm looking to build that up. I think at scale, I'd like to see SCHD at about 20 to 25% of the portfolio, and then VDY at probably about at least 10 to 15%. I'd like to build those up a bit, and then over time, if Tesla gets to where I think it's going in the next 3 to 5 years, I'll scale that down and really boost up my dividends through VDY and SCHD. It's just right now, I feel like we're in the next, I'm going to say 1 to 2 years, 1 to 3 years, we're going to start seeing a recovery in a lot of companies in SCHD and VDY. I think those are going to be the recovery plays that have really lagged the broader market when it comes to tech that has really led. I think Tesla will eventually start seeing the benefit in auto sales. I think a lot of companies, like I said, I think we're on the second phase of growth here. The phase of growth we were just in was margin expansion, which means we need to cut costs, we need to expand the margin, increase earnings. We can't be spending like willy-nilly just throwing money around like we were. And that's the phase we went to, which was strengthening these really valued businesses because things were tough. Now we're going to go into a loosening cycle with very strong fundamentals and a tightened up business model. So I think we're going to head back into a new growth cycle. Honestly, a lot of people have been very bearish on the markets. I've been bearish by valuation, but the valuation will make sense if, again, earnings and revenue continue to propel and we don't head into a deflationary cycle where people start cutting a lot of costs to get consumer spending up. I don't know if consumers are that tight, but this is a great time to start loosening when consumers are starting to really cut back. So time will truly tell here, but I'm bullish. I'm always a glass half full guy. It's led to incredible gains in this portfolio. We're well over 250,000 now. That's going to continue to propel forward, I think, and I'm very confident, and I'll pass the question off to you. I'd love to know what you think about this first interest rate cut here in Canada.